My largest stock position of 2026 is Nvidia, ticker symbol NVDA. I have $111,000 invested across multiple accounts. All of this was added in 2026. I didn't own any going into this year. Now, normally I follow a dividend growth investing strategy. I spent years studying the value investing principles of great investors like Warren Buffett and Charlie Munger. I've been updating my personal dividend portfolio on this channel every single month going back for 5+ years. However, I definitely lean more towards tech. I bought a big position of Microsoft earlier this year. I bought a big stake in Google in early 2025. And this goes along with some of my high yield, high income stocks. I recently even added Nvidia to my dividend portfolio. Now, this is not really known to be a dividend stock. They did not raise the payment for many years. However, Nvidia is generating a ton of cash, so much they have a lot of excess free cash flow. And they recently raised their dividend payment by 2,400%. But that's not the reason why I'm buying Nvidia stock. The reason is due to the explosion in cash flow this company is generating. $48 billion of free cash flow just in the last quarter. That was up 85% year over year. So before the company reports earnings next week, I wanted to give you my updated thoughts on Nvidia stock and explain why it's my largest overall position. I even created a nifty little PowerPoint to help explain my overall thoughts. And of course, I'll do a deep dive into the company, their financials, what analysts are expecting in the coming years for growth, and even give my thoughts on whether the stock might actually be undervalued despite being the most valuable company in the world. And as someone with a value investing background, I'll give my thoughts on why I don't think we're in an AI bubble right now, and why Nvidia's cash flows will continue growing in the coming years and may actually prove to be durable. With that said, let's roll the intro and get into today's video.
The following reflects the opinions of a man who spends far too much time thinking about stocks. Please do your own research before making any investment decisions. Nothing in this video is personal financial advice. Continue at your own risk.
My name is Zach. This is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout, I'm going to be using the best stock research tool, which is available at dividenddata.com. These are the exact same portfolio tracking and stock analysis tools that I use. We just put out a massive update last month. It's basically a relaunch of the entire product. And to celebrate that, we're doing a deal where you can get 50% off annual membership and lock in that price for life. Think of this as being a founding member of the tool. So if you like what you see throughout the video and want to try out dividenddata.com, click link in the description and pin comment. Scan that QR code in the bottom right corner and you can get 50% forever. And the offer expires on Labor Day. So it's only going to be available for a limited amount of time. So let's get right into the meat of the video. Why I own $111,000 of Nvidia stock, why it's my biggest position of 2026, and why I chose to add it this year. Many of you are probably thinking, Zach, Nvidia is the most valuable company in the world, a $5.32 trillion market cap. It's gone up 1,000% over the past 5 years. And you've already missed a lot of the crazy gains in stock price since the AI build out really ramped up. After all, Nvidia's stock isn't the hot thing anymore. It's not where the gains have been lately. It's only up 25% over the past year, while there are tons of other stocks in the market up way more in that time. Nvidia's up 16.3% year to date. And to that, I'll kind of agree. With my investment in Nvidia, I'm not expecting another 1,000% over 5 years. However, I do think the stock has consolidated quite a bit over the past year. It's becoming quite attractive relative to its earnings growth. It has a lot more fundamental growth on the horizon. And ironically, this high growth AI company is becoming somewhat of a value play. And people don't really know what to do with the stock. After all, it's the most valuable company in the world. They look at a $5.3 trillion market cap and they say, how much bigger can it get? Most of the returns are already done, but you can't just look at it that simply. You always have to look to the underlying asset, the actual business in this case of Nvidia, the cash flows they're generating, the growth ahead, and then you have to think about what kind of multiple the company should trade at. And simply looking at a high market cap and discarding the stock has been a mistake in the past with a lot of the big tech companies. For a while, people said you couldn't have a trillion-dollar company. And now if you look at it, there are $16 trillion companies right now. And there are multiple big tech giants that are at 4 trillion, 3 trillion, 2 trillion. And today I'm going to make my case for why, in my opinion, I think Nvidia will be the first $10 trillion company. So yes, that's not 10x in 5 years, but I think a 2x in 2 to 3 years is still pretty attractive and beating the overall market. And I think that's pretty possible in a risk-adjusted sense with Nvidia. So I'll dive into all the financials and give you an update on the actual business of Nvidia. That will include a look at the valuation of the stock, what kind of multiple they're trading at, and the expectations for growth in the coming years. But first, I wanted to give you just a little bit of a big picture look, like the business case, the thesis behind owning Nvidia. If you don't know, the company's entire business right now is basically just building data center infrastructure. It is no longer just the GPU used to play video games, and we're not talking about just one chip. We're talking about an entire system. It's used for both the training and the running of AI models. If you're not as familiar with AI, this would be called inference, the actual running, the usage of the model. And if you're analyzing Nvidia stock, the whole story is the data center. It's now 90% of their overall revenue. It's the main growth driver. It's the whole story. So Nvidia, they are selling the infrastructure layer. They sell the best system. It's the most energy efficient. They charge a premium. They have 75% gross margins. And at this current phase of the build out, anything Nvidia can actually produce, they are going to sell. If you run a cloud, if you run a data center, you are likely going to be buying Nvidia systems. Now, of course, you'll want to mix in diversification, and they don't want to be entirely reliant on Nvidia forever. So you have a lot of companies designing their own chips. You have competitors entering the space as well. But the reality on the ground right now is that Nvidia is still in a very dominant position, and the entire pie is growing. Every AI model can run on Nvidia hardware, whether it's from OpenAI, whether it's Anthropic, whether it's Grok, they all run on Nvidia. All of the open source models, they run on Nvidia hardware. So with my investment in Nvidia, it basically has 3 pillars. One is that AI token demand continues to grow. This is usage of AI. 2, the work is productive for the people paying. So the people using the tokens will continue using tokens. And 3, the build out continues to be funded. And right now, all 3 of these are still true. Number 1 and number 2 continue to be more true month after month. The models continue to get more intelligent, able to do more capable work. We're seeing tons of innovations if you're following the space. Just in this past year, we had coding agents and agentic harnesses, and this has been a huge growth driver in the industry. So we've seen an explosion in token demand this year. And basically every sign is pointing to this is going to continue exponentially for the foreseeable future. And that brings us to today. We are in a compute shortage. Everyone right now wishes they had more compute. That's why the build out is continuing and ramping up. That includes the frontier model companies, OpenAI and Anthropic. They would all be making even more money if they just had more compute. They are constrained. They have usage caps on their users. The token demand has been exploding with coding agents and agentic platforms, and month after month after month, there's continued model advances. And basically what was the frontier 6 months ago is now readily available and cheap. But that calls a thing that, if you've been following this, the idea of Jevons paradox is being passed around. And that's the idea that the smarter and the cheaper the AI models would get, the more they would be used. So overall demand would continue growing. Why? Because it's more useful and more affordable. And one example of this in the real world is Anthropic. They saw their revenue hit $65 billion in forward-looking annualized revenue. They have now 10x'd 2 years in a row. And in December, their forward-looking revenue was $9 billion. And so far, they just reported that last month was $65 billion. And right now, a lot of this growth is primarily being driven by coding agents. Claude Code has been a hit product, and their models are the best coding models right now. So we are talking about something that was considered to be a very high skill and high paid job. And Anthropic, as one example, is helping to accelerate that field, allowing high skill workers to be more productive. So this was one of the first breakthrough use cases for AI in an enterprise setting, and that's why the spending ramped up crazy. And agentic coding, it's still getting started. It's kind of crazy to think about if you've been in the space and you're living it day to day. We're still very early in that ramp up. But this is a thing that's going to happen in a lot of other areas of knowledge work. So as we go back to Nvidia, we're in a compute shortage. The data center build out is continuing. As we said today, all of the cloud giants, Amazon with Amazon Web Services, Microsoft with Microsoft Azure, Google with Google Cloud, they all reported earnings. They all crushed earnings. They have a huge revenue backlog, and they're all raising CapEx guidance so that they can invest, build the infrastructure to serve those contracts and demand. We even have more companies entering the race. We have Meta ramping up their CapEx massively to match those other hyperscalers. We have SpaceX building a ton of data center infrastructure, and we're seeing them rent out that compute at an ever-increasing top dollar to both Anthropic and Google. We have OpenAI and Anthropic both accelerating as businesses. They're not slowing down. And if you've been following, there's been rumors for many, many months that Anthropic has recently been having positive operating income in some of these months. And this is ahead of their internal expectations. They were not expecting to do that. Right now, both these businesses are in hyper growth mode where they're investing in future training runs, buying more compute. But because Anthropic is more concentrated in enterprise AI, they have higher margins on their API. And they were not as aggressive as OpenAI in securing more compute, which has actually been kind of a negative. Their growth could even be higher if they had more compute. But because of that, the rumor is that Anthropic has been having positive operating income recently. The data center build-out is broadening to more customers. One critique of Nvidia was that it was all concentrated in the hyperscalers who are all servicing the frontier model companies for the most part. But in recent quarters, the build-out has been broadening. You have all the different neo clouds, whether it's CoreWeave and stuff like that. There are tons of these different small clouds. You have enterprises building out their own data centers. Companies like Dell are involved with that. They have customers like Eli Lilly. They're building out data centers to help with drug research. You have sovereign governments building out data centers. I think Japan did one recently. Saudi Arabia is doing them. And you have this huge news from SpaceX that just came out on this latest earnings call. And if they hit even a quarter of what they're targeting, it's going to be a lot of money flowing towards Nvidia. And I guess we'll go right into that. SpaceX, they said that they are going exclusive with Nvidia. And if you've been following SpaceX, the story, it's twofold with the AI build out. Long term, they're planning to do orbital data centers. And no, these aren't these giant things. They're satellites, similar to how they designed Starlink satellites. They're going to have solar power and compute on board. But in the short term, if you haven't been following the story, xAI, which has been acquired by SpaceX, they have proven to be one of the most capable builders of data centers. They have built some of the largest in the fastest time frame. So this would be terrestrial compute, which would be on land, the traditional data center model. And on the latest earnings call, Elon said they're targeting to bring 5 to 10 gigawatts online in 2027, which of course, because it's Elon, that's a crazy target. But even if they just do like 4 to 5, this is a ton of spend that would be going towards Nvidia. And the reason why this matters is because these are new kind of demand signals that analysts weren't really thinking about last year. And I don't even think Jensen was thinking about it at this scale, where earlier in the year, this was at Nvidia GTC, an event that was back in March, he mentioned that he saw line of sight to $1 trillion of revenue in the next 2 years, 2026 and 2027. And since then, I would say the overall demand has only increased. So this is likely a sandbagged number they're going to end up beating. And right now, things are looking even better for 2028. And it was that $1 trillion revenue number that really started getting me interested in Nvidia stock. And it's because I was diving into the financials and I noticed how much free cash flow they're generating. They generated $81 billion of revenue in the latest quarter, and that was $48.5 billion of free cash flow. So I think it's pretty reasonable to say that over the next 2 calendar years, Nvidia will generate over $500 billion of free cash flow, which is an absolutely insane number to think of. And they will be going into 2028 growing from that base. Now, I just want to provide some context here about how much that is. If we sort by operating cash flow, Alphabet generates the most operating cash flow in the world at $185 billion over the trailing 12 months. That's followed by Microsoft at $182 billion and Amazon at $161 billion. However, these companies have massive capital expenditures, which is going into building out these data centers. Part of that money is going to companies like Nvidia. So their free cash flow is actually lower. Amazon's is even negative over the trailing 12 months. So if we look today, the most free cash flow generated in the market is Apple at $136 billion. That's over the trailing 12 months. Nvidia is second at $119 billion. And it's possible that in 2027, Nvidia could generate $300 billion of free cash flow. And over the next 2 years, $500 billion. Now, us as investors, why does that matter? Well, ultimately, a company is worth the present value of all the future cash flows they will generate. And with those earned cash flows, they could reward you as shareholders. They could buy back stock. They could pay out dividends. Over the trailing 12 months, Nvidia has paid out $48.4 billion back to shareholders. $47 billion of that has been share repurchases. The dividend less so, but they just raised their dividend payment by 2,400%. Nvidia is starting to be a cash generating machine, and actually the largest one in the history of the stock market. In the coming years, Nvidia will be building up a war chest. They will be becoming a very heavy company. As Warren Buffett says, in the short term, the market is a voting machine. In the long run, it's a weighing machine. Nvidia is becoming a very heavy, real business. They are going to have hundreds of billions of dollars in cash. They are going to have assets, large equity stakes, and a lot of these different AI companies they're investing in. They're going to have hundreds of billions of dollars of cash flow coming in. That's a heavy, real, valuable business in a field that arguably has a lot of growth on the horizon. I know a lot of value investor people are on the AI bubble, but I'm telling you, I think the reality is that in the long run, we're still very early. AI is going to be a multi-decade story. It's going to completely transform society when we talk 20, 30, 40 years out. The data center build out is early. The diffusion of models and AI use in society is early. So before I get back to the overall big picture story, let's dive into the stock analysis part of the video. I'll go over the financials, the growth, expectations for the coming years, and why I think it could still be of value right now. So if we take a look at Nvidia's earnings, you can see that their forward-looking earnings per share is $9. This is what analysts are expecting for the full annual year. That is a 24.4 PE ratio on a forward-looking basis. So that makes Nvidia stock cheaper than some companies like Coca-Cola and Procter & Gamble. Over the trailing 12 months, it has $5.84 in earnings per share. This is non-GAAP, and it's $6.53 in GAAP, which counts some investment gains. Nvidia has some equity stakes in Anthropic, OpenAI. I think they also have some SpaceX, and they've been investing in some smaller data centers as well as a bunch of other AI labs. So their PE ratio over the trailing 12 months is 33.65, which really is not that expensive when you look at their growth. So you can see here, adjusted EPS is up 83% year over year. The latest quarter, which was $1.87, which was the new high. They're growing to a new high basically every single quarter. They had one dip, and that was because they had to stop selling to China. All of these numbers would be massively higher if they were able to continue selling to China. So Nvidia's business is now heavily weighted in the US. You can see it's just under 70% US revenue, 19% Taiwan. It's still 9% China, but they had to get rid of a lot of that business. You can see going back to 2024, the US revenue was only $26 billion. So this latest quarter was 130% growth year over year. But that was comparing to that quarter that went down from the China exclusions and some one-time losses they took in that quarter as well. And since then, they've been on a continued ramp up, and expectations are that it will continue ramping up. So here I have a tool called the PE Analyzer. It shows the daily PE ratio of the stock over the selected time period. In this case, we're looking at 3 years, which is really when a lot of this AI boom at Nvidia has started. In that time, the company is traded at a median multiple of 51.61. That's trailing 12 months PE ratio. And right now, we're at the bottom 9th percentile. So Nvidia stock is trading cheaper than ever while it's growing 80% year over year. And if we look over the past 5 years, it's in the 6th percentile. And if we look on a forward-looking basis, the median multiple over the past 5 years has been 38.31. Nvidia actually used to trade at a pretty high multiple even back in the day before the AI data center build-out started. And that's because it's a very high margin chip company that was operating in categories that were seeing fundamental growth. And even back then, they generated a ton of free cash flow because of their fabless business model. They get their chips manufactured by TSMC. They operate as the designer, and it's an incredibly capital light and high cash flow business. Over the trailing 12 months, Nvidia has generated $253 billion of revenue. That's up 70% year over year. Over the past 5 years, revenue's up 944%. That's a 68.73% compound annual growth rate. And if quarterly revenue doesn't pass $100 billion this coming quarter, it definitely will the quarter after that, which will put them on pace to $400 billion annually. And then with that $1 trillion over 2 years, that would imply that they're going to be passing $400 to $500 to $600 billion. And right now, Nvidia is on their Q1 2027 fiscal year. They completed their 2026 fiscal year in that they had 71% gross margins, 60% operating margins, 55% net margins. This is a very high margin business. Here you can see the free cash flow that the company generates, $119 billion over the trailing 12 months, up 65% year over year. Over the past 5 years, that's up 1,564%, growing at an 87% compound annual growth rate. The most recent quarter was $48.59 billion, up 85% year over year. And since that was Q1 at $48 billion, I would expect they're well over $200 billion for fiscal year 2027, probably closer to $250 billion. And this is a company which just 2.5 years ago had $10 billion of trailing 12 months free cash flow. And when you zoom out, you can see the ramp and how crazy it is. It's even crazier on a quarterly view. And Nvidia is a very capital light business model. Over the trailing 12 months, they have $6.5 billion of free cash flow, which relative to the cash they're generating is a drop in the bucket. And I believe most of this is being used to build their own data centers. Basically, with every new generation of hardware, they like to make their own flagship data center. The company is actually incredibly impressive with how they co-design with all of these different data centers. They have these whole virtual world setups where they can analyze and do a bunch of modeling on them. Honestly, if you wanted to just learn more about Nvidia, I would recommend going and watching the GDC conference that they had earlier this year, because it actually is so interesting how the work they've been doing over 10 and 20 years that wasn't necessarily seeing a lot of economic benefit at that time, whether it was building physics engines and all these things for video games. All of those things stack and they're becoming more and more useful. And all of the different applications that Nvidia can help with, it's pretty interesting. Now, of course, because this is dividend data, we have to mention the dividend payment. And they did just have a 2,400% dividend increase. So the new forward-looking dividend is $1 per share. That's a 0.46% dividend yield. So this is still a low yield stock. However, the company will have continued capacity to grow that dividend payment. As you can see, their cash flows are rapidly growing. This prior dividend payment they had over the trailing 12 months, that was a 1% payout ratio. So we can do a little back of the napkin math here with this $1 forward-looking payout. Free cash flow per share over the trailing 12 months is $4.90. So it's around a 20% payout ratio. And you can see their free cash flow is rapidly growing. So this new raised payout will very quickly go back to a 10% payout ratio, probably a 5%, and then probably back down to 3 to 5. So we'll see if they continue raising it going forward. However, the dividend is not a big part of my investment case with Nvidia. Now let's take a look at some of the analyst estimates for Nvidia stock. I'll be giving you my thoughts on why the company may be undervalued right now and some price projections for where the stock could be 1 year from now, 2 years from now, and even 4 years from now. And then if you stick around to the end of the video, I'll give my thoughts and my plan for Nvidia stock and under what scenario that would break my thesis and where I would sell. So here we can see the earnings per share estimates for Nvidia stock. This is among Wall Street analysts. The current 2027 consensus is $9 per share in annual EPS. That's where we get this 24.4 forward-looking PE ratio. And we're almost halfway through that year because next week they report their Q2 2027. And you can see analysts overall, they're expecting continued growth, but it's actually not as high as it was over this past year. They're expecting 42% growth in 2028, which would be a 17.2 P ratio. And I'm going to be honest, just from my following things on the ground, I think that is probably underestimating it. I wouldn't be surprised if they grow 80% year over year again. However, part of the problem with Nvidia stock right now and why it's been consolidating for about a year is that investors, they really have no idea what 3, 4, or 5 years is going to look like at Nvidia, where the data center build out's going to be, whether it can continue ramping up or if it's going to hit a steady state or if it's going to decline slightly. And frankly, I have no idea either. I just feel fairly confident that in the next 2 years, there is very clear demand signal that it's going to continue growing. And that's part of what my plan investing in Nvidia stock is. More on that later. Currently, analysts are projecting $393 billion of revenue in fiscal year 2027. They're expecting $563 billion in fiscal year 2028. And if you add those together, you get close to that $1 trillion mark that Jensen mentioned. But honestly, the analysts are a little bit short of that. And Jensen, he basically, all of his guidance, if you look back historically, he always sandbags it a little bit so they can beat it. And I think that $1 trillion number, they're probably going to end up beating it. So I would say these analyst estimates are a little low over the next 2 years. But interestingly, on the revenue side, analysts are expecting continued ramp up, even hitting $1 trillion in 2031. So what is Nvidia stock worth? Is the company potentially undervalued? I'm going to give some thoughts on that as well as a price projection on the stock. And if you've been liking the video, the best way to support the channel is to use dividenddata.com. Join our pro plan. It's currently 50% off. So you can get half off annual membership and lock in that discounted price for life. And the reason why we do half off on annual membership is because we're a community of long-term investors. So we want people that are committed to investing long-term. So if you join, you'd get everything I've been showing throughout. You get to use the same stock research tools that I use. I designed what I personally want to analyze stocks. And if the tool helps you find just one better investment, it way more than pays for itself. Link in the description and pinned comment, scan the QR code in the corner. So here we're going to be taking a look at the value graph, and this basically gives you an implied fair value based on the median multiple of the selected metric: earnings per share, dividend, free cash flow, operating cash flow, revenue. So you can see over the past 5 years, adjusted earnings per share for Nvidia stock has traded at a median multiple of 53.78. This is over trailing 12 months, and currently it's at 37.63. So the stock is trading below that implied fair value if it went back to the median. You can see if it goes up back to that 53 trailing 12 months P ratio, that would imply a fair value of $314, which would be 42.9% upside from here. And then of course, it's a growing business. The fair value is growing over time. If we look at it based on free cash flow, trailing 12 months free cash flow for Nvidia, the median multiple over the past 5 years is 64.73. Currently, it's 44.82. And again, we're talking about trailing 12 months. And with how fast Nvidia is growing, I think it's always better to look at forward-looking metrics here. And that's why when we go back to the forward-looking earnings per share, you can see the current forward-looking is 24.42. That's a forward-looking P ratio. So if Nvidia, they start trading at their trailing 12 months free cash flow multiple of 64.73, that would imply a fair value of $317, 44.4% upside from here. But what if Nvidia doesn't get re-rated upward? They stay at this forward-looking P ratio of 24.4. What kind of returns could you expect in the coming years? Well, here we can see what the analysts are projecting in earnings per share in the coming years. So if they trade at 24.4 multiple in the fiscal year 2028, where they're projected to earn $12.78, that would imply a share price of $311.74. So what would that be? That would be 41.8% growth from today's price in the span of about a year. And the stock doesn't have to be re-rated upward at all. It's all because the actual fair value, the fundamentals of the business are growing. By fiscal year 2029, it would imply a share price of $373. So that would be 70% upside from today's price in the span of 2 years. And this is kind of what my investment case for Nvidia stock has been. I don't think you need any magic. I think the business is just going to continue growing. And if it trades just at the same forward-looking multiple it is today, the stock price is going to be a hell of a lot higher in a couple of years. So I bought a good bit of Nvidia stock at around $190. If we look at my overall position, my cost per share is $188.22. Across all my accounts, I'm up 16.84% so far. Again, I bought that this year, and I'm planning to hold it for at least the next 2 years. And I'll be reevaluating that as I'll have more line of sight in about a year and a half about what the demand looks like in the coming years. But I made Nvidia basically 100% of my Roth IRA. I like to do a more concentrated investing approach. Don't just blindly follow me. This is just me sharing my analysis. You do your own research for any investing decisions. But you can see in my Roth IRA, I have a cost per share of $182 on Nvidia. I'm already up 20%. And from the cost basis that I purchased, I thought it was pretty likely they would have a 100% return over 2 years. And the benefit of holding it in a Roth IRA is that I can then sell that with no cap gains. And once I just started thinking about that, I agree that I don't necessarily know what the AI build out picture will be like 3, 4, 5 years from now. It could continue going up. I'm not sure, but I feel pretty confident about the next 2 years, and I follow it really closely. And I thought Nvidia stock looked like a pretty attractive value over the next 2 years. So this might just be a trade that I'm looking to hold the stock for a couple of years, sell it, invest in a different thing in my Roth. But I also do believe in Nvidia's competitive advantages, the overall business, and there could be a case where I end up holding this stock much longer. So I even added to it in my dividend growth portfolio, and this is probably going to be a more long-term position that I'd be less likely to sell, as this is just in a regular taxable brokerage account. I have about a $33,000 stake in my dividend portfolio. I got this at a little bit higher of a cost basis, $200 a share. So I'm up 9.3%, but I bought this like a couple months ago, maybe a month ago. So in what scenarios would I sell Nvidia stock? Well, it's actually pretty simple. I would be analyzing the situation, the same factors that I'm using to analyze how I think the build out is going and the spend ramp up. And the big thing is just whether we overbuild compute. That would be the scenario where Nvidia stock would not do well. You would see CapEx guidance coming down from the major cloud providers. If you saw AI demand decline, that would be a signal. That would be a huge shift, though, from where we're going today. So the bear case for Nvidia, where I would consider selling my position, it would basically be where it's the exact opposite of what it is right now. Just invert everything happening right now. Instead of a compute shortage, it would be a compute glut. Instead of accelerating token demand and more intelligent models at a lower cost, massive demand spikes, it would be lowered token demand, no growth. Instead of many different large cloud companies and a diversifying revenue stream of potential buyers, it would be companies going out of business, not building these data centers. That would be another sign. CapEx coming down, basically. Now, ironically, part of the bear case for AI is that everyone hates it. There's been some local pushback with building these data centers. I'm sure you've seen it online. And there are a lot of real world constraints going on with the actual build out of data centers and NVIDIA's infrastructure in general. We have a huge memory shortage. We're constrained by chip producers like TSMC. So NVIDIA themselves, they can only actually get so much supply built. Memory is a part of their stack of their infrastructure. There's a huge shortage that's going to last at least a year, probably a couple more years. And it really depends who you're talking to, thoughts beyond that. And then all these data centers, they need power online as well. And that is typically now being done behind the meter. So they're bringing their own energy. They're using natural gas turbines. They're using solar. They're building their own power. And in the cases which they use the grid, which is becoming less common now because of the political reasons, and also just realistically, these things use a ton of power that they can't be on the grid. The grid's not prepared for that level of growth and demand. So ironically, it's these constraints in the real world that will probably prevent an overbuild in data center infrastructure and AI compute. And in my personal opinion, I think the demand for AI and tokens will continue ramping for a number of years, well ahead of the actual compute supply available. So the bull case for Nvidia stock would be that there's a compute shortage for years and years and years to come. And they continue to develop even more efficient systems that people want. Anyone building a data center will choose them because they will make the most money with NVIDIA infrastructure the most reliably. So there is a scenario where this $1 trillion over 2 years, that could be the normal, and they could continue growing from that base. And who knows, in the 2030s, they could have a year where they have $1 trillion of revenue. So in my opinion, I made the case today for why I think NVIDIA will be the first $10 trillion company. But I don't think it's ridiculous at all to say that they could keep growing from there over the long run. NVIDIA realistically could be a $15 trillion company, a $25 trillion company. In fact, I think a lot of people will be surprised with how big these big tech giants end up being 10 years from now. I mean, of course, you have Elon saying crazy numbers for SpaceX, but I actually think quite a few of these companies could be $5 and $10 trillion companies by 2030. And if you're investing in the broader market, you better hope so, because these are large percentages of the S&P 500, the NASDAQ 100, the Dow Jones. If you own the S&P 500, you have a 7.59% weight in Nvidia. So that's my thoughts on Nvidia stock, why it's my top holding. If you enjoyed the video, make sure to leave a like, comment, and subscribe to the channel. Also, you can watch and listen to these on Spotify if you want. I don't mention that often. But we have a small base of people that is actually their platform. They listen to the show. And if you want to use dividenddata.com, it's the best stock research tool. We put out massive updates earlier this year. It's improving rapidly. The feedback has been great. I'm so happy with everyone that has been sharing that they're liking the tool. So you can try it out for free. And as I mentioned, we have that 50% off sale. Joining dividenddata.com, it's the best way to support the channel and the research we do. And I do think the tool is really good. It's no joke that if it helps you find one better investment or just avoid a mistake, it way more than pays for itself. It's built for people that are long-term investors and actually making investment decisions. They're investing thousands of dollars a month, their personal finance. They are managing their own portfolios. And if you're someone who falls into that camp, I think it's a no-brainer just to have a tool that gives you good data, good information, and just helps you make better decisions. So with that said, thanks for watching, and I'll see you in the next video.